0.75% of GDP is being spent on extra payments for oil that really have to get paid because it's essentially a necessity. And so the real question is, where does that come from?
What this war has revealed, what the market is yelling out at us as the little girl, as the missionary, is that, oh my God, the Strait of Hormuz means everything for the global economy.
The reason I care about 100 in oil, because I think if crude breaks 100, I think VIX goes to 50. And then I think the equity market probably has some very, very ugly days.
You're watching Excess Returns, the channel that makes complex investing ideas simple enough to actually use, where better questions lead to better decisions. This is Last Call. This is our monthly show where we talk about the stuff that actually mattered in the last month, not the performance of stocks, bonds, commodities, all the other stuff. You can look that up yourselves on your Clodbot reinvented terminal or whatever you kids are using these days. Well, what we're doing is we're tapping some of the smartest people from our network. We're pulling them back onto the show with us and getting just like, what was the most important thing this month? So they talk about it with us. Jack Forehand, how's it going?
It's going good, Matt. And I can't think of two better people to analyze the Strait of Hormuz than you and me, right? I mean, I've been Googling this thing for at least a week. So, I mean, I've got incredible knowledge now on this.
I've got at least a week and a half of Strait of Hormuz knowledge in my brain right now. So I feel qualified. But what's crazy is for all the market events, A, how quick all this stuff is going down. And like B, for all this stuff as we're going to get into with these guests, like all the different layers of this onion. Because we're talking about the consumer, we're talking about commodity prices, we're talking about economic shocks, what it means in the US versus in the rest of the world, what it means for options and dealer flows. Like there are so many layers to this onion. Nobody knows anything. So we're going to try to learn something, right?
Yeah, and I can't think of three better people to talk this about. I mean, if you wanted to take this whole situation going on, the oil shock, the war in Iran, and you wanted to analyze how it's impacting markets, and you wanted to do it through a macro lens, a narrative lens, and then look at the flows behind the scenes, we've got brand new interviews with three people who are the exact people I'd want to talk to. We've got Andy Constan on the macro side, we've got Ben Hunt on narrative, we've got Brent Kochuba on the flows. So we just for this thing, and then we've obviously got Eric Pachman with a really, really interesting thing at the end. So we've got a great collection of people, brand new interviews, and lots of stuff to get through.
Lots of stuff to get through. You want to tell us what Andy was talking about first, and let's dive right in?
Yeah, let's dive right in. Yeah, I mean, usually you and I do a little thing where we break everything down, Matt, but I think given the quality of the guest this time, it probably wouldn't make sense because whatever we said would probably be quickly refuted by the people who actually know what's going on.
Can't argue with that. What did Andy talk about?
So Andy, I want to talk to Andy about an oil shock in general, like how it works. And then Andy has a really interesting chart in here. He's looking at the different scenarios that could play out, because one of the things you have to be really careful about with a situation like this is anybody who's telling you this is the way it's going to play out, like no matter how knowledgeable they are. I mean, think about this is all being driven by one tweet at a time here. Like nobody has any idea how this is going to play out. So Andy did a really good job of looking at the different scenarios and looking at what might happen. So here's my interview with Andy. Andy, welcome to Last Call.
Hey, how are you, Jack?
I'm good. I'm really excited to have you on because like many investors, I'm trying to make sense of this whole Iran war and the oil spike and everything that's going on. And you always provide such a balanced take on this. So I want to start by talking about oil shocks in general, because I know you've studied a lot of them historically. Like, what should investors like me take from how to think about the impact of an oil shock?
Well, I mean, oil goes up for lots of different reasons. It goes up for real demand, and that tends to be extremely inelastic. Like demand doesn't really change very much over time, no matter what the price does. So what tends to happen is that oil price changes have a lot to do with marginal supply. And so when you have a supply shock like we're seeing today, oil prices rise rapidly. But demand doesn't typically get curtailed much because it's inelastic. And if you look over the 60 years since oil's been sort of volatile and subject to supply shocks, the only time you've even seen any sort of demand decline is in supply shocks that were 5x the sort of supply shock we're experiencing today, meaning prices went up 500%, not 30%. And that was in the 70s. And then you've had a couple of demand shocks. well, we have the supply shock today, and we had a supply shock a little bit in the Ukraine, but you've had a couple of demand shocks that caused some consumption to fall, and that was the GFC, which honestly, consumption, if you look at the chart with any sort of longer-term perspective, consumption really didn't change. Only COVID really caused a real consumption drop-off, and that was because we didn't need the energy. We weren't driving and doing other things. So demand shocks are extremely unusual. Supply shocks are very episodic, and we've had five or so of them. And so what typically happens is that consumption remains strong. And that's pretty straightforward in terms of what has to happen. If you're paying 35% more for oil, which, we consume, I don't know, call it 100 million per day globally. Or just let's use the U.S., 20 million per day in the U.S., 707 billion barrels, the math. Times 365 times 30 extra dollars per barrel, you get a number like 0.75% of GDP is being spent on extra payments for oil that really have to get paid because it's essentially a necessity. And so the real question is, where's that come from? Where's that GDP come from? And it most likely comes from reduced consumption of other things. So that tends to be where the negative real growth impact of supply shock driven oil price changes flows through in terms of a linkage. Now, of course, inflation itself is, and particularly the calculation of what inflation has been, is dramatically impacted by an increase in oil. Roughly a 30% increase in oil with a 5%-ish. And, the numbers can be 2%, they could be 7%. What flows through the headline, is going to be a fairly, 1-ish% increase in headline inflation. But that stops inflating when you have oil stop going up. And so, that is by definition a transitory impact. But because of that, and I think more importantly, if you step back, we've had 60 months of above target inflation. So we were having an inflationary environment with $60 oil. And so it's very difficult for the central banks to offset the negative growth impact that I just mentioned, while inflation was really not under control to begin with. And again, these are backward-looking prints. They're going to be high in the next year. But they are, by definition, transitory. Once the supply shock ceases, we get disinflation from oil prices. But they're just not going to be as willing to ease. And if the thing escalates and we get, significantly higher oil for much longer, not only are they going to be unwilling to ease, but they're going to really be unable to ease. And so that's sort of how I look through the supply shock. And the supply shock could end randomly, or it could persist depending on how much productive capacity is destroyed. Those are sort of unknowns.
I think the word transitory you use is one that's important to think about right now. And I want to put up this chart you had. You were nice enough to give us a chart from one of your premium products here at damspring.com. And you're talking about different scenarios for the oil price. And, can you just talk through this and how you think through a scenario like this and how it might impact the price of oil and other things depending on the scenario we get?
Yeah, and I just want to start by saying I have no idea how it's going to go. I don't know. The war could persist. The war could escalate and damage a lot of productive capacity. And the war could end peacefully, either in a sort of ceasefire ongoing risk way or a resolution way. Now, I'm not a particular believer in the war ending in a resolution, except in two sort of very different circumstances. one, the U.S. loses its nerve, and that could happen for a variety of reasons. Typically, people like to think it's the stock market, the bond market, whatever it might be, inflation at the pump. We could pull out without achieving our goals. And then the other thing is we could achieve our goals and eliminate the nuclear threat, eliminate potential, take control of the Hormuz Strait, all those sort of things. But so those are circumstances where it's completely resolved. More likely you get a ceasefire-like resolution, and so you have ongoing issues. But if you take it just to think about where will oil be a year from now or 9 months from now, December oil contract is priced at $77 a barrel. There's some risk premium in it, so the expectation built into where future oil is likely to be is probably a little bit higher, just picking a round number like 80. Living with $80 oil all year and ending the year at $80 is going to be a significant hit to growth. On the other hand, there's obviously some productive capacity damage. People will point to the LNG fields. There is some productive capacity damage, but assuming it's low and we resolve the war and oil returns to where it really had been trading from a supply and demand basis, 60-ish or lower, that will put us right back onto the pre-war growth consensus and allow the central banks to find their way to neutral and significantly de-risk the market, meaning the elevated volatility that we now experience would drop fairly rapidly. And so there is a very bullish scenario, certainly with oil falling to 60.
So it seems like, because we had Bob Elliott on earlier this week, and he was talking about this idea that I used the title, "Nothing is Priced In" for my YouTube video because he had said something like that. It seemed like, do you agree with that? I mean, is it not much of these scenarios? Like, it seems like your $100 or greater scenario is definitely not priced in, and probably the $80 one's not either. Do you feel like the market hasn't really discounted much of this yet?
Well, I think it's getting close, to be honest. I try to be as neutral as possible. I'm not a doomer. I'm not a super optimist. I like to be long way more than I like to be short. But, going into the war, the situation for growth and inflation was not great. There were a lot of positives for the last, the 6 months ahead of the war. Expectation of Fed rate cuts, low energy prices, consumption that had been held up by dissaving and modest wage growth, but relatively full employment, and supported by a stimulative OBBB, which is providing consumption ability for the largest part of the economy, the consumer, and high asset prices. And that had been held up, but also by significant AI spend, which had supported GDP. That has kept asset prices elevated. I didn't think that was a particularly good thing to bet on going forward, that we would continue to see that, because the OBBB impact turns into not a fiscal cliff, but it certainly isn't expansionary anymore, in a few months. By the way, also before all this, the market was being supported by the Fed ending QT and beginning to buy T-bills. The Treasury was keeping tariffs reasonable. The only positives I see right now, I don't see OBBB turning into a big, once again passing and being expansionary. I don't see the tariffs are likely to come down. That's probably a tailwind for growth. And Trump could say, he's now at 10% tariffs. He promised to go to 15% before the war and never did. He could say, you know what, enough with the tariffs. We're going to end the tariffs. And that's going to be expansionary. So there are levers for the Trump administration to offset some of but they're nothing like the sort of levers that had been in place up until the war. And so, if we were to have $60 oil again, I think we go back to where we were, which is a market that depends entirely, which no longer has fiscal support, which no longer has central bank support, and now is challenged with whether the AI investment will continue and be able to get financed in the market, and the consumption, the savings to continue to support consumption. And I think that was a tough bet for me to make before the war. It's even tougher today because time has happened and the OBB impact is fading instead and turning into a headwind. So I don't love the upside at $60 oil, but we would see a pretty meaningful recovery if the tensions in the Middle East ended. So I guess my point is the upside for assets is okay, but oil, if it were to fall from 80 to 60, would make somebody 33% on a short. You can be short oil at 80 if you think, and I think that's a much better trade than being long assets. So I think that's the essence of the mispricing, that assets will rise less than oil will fall. Similarly, if we are in active war for a while, there's going to be significant hits to growth. There's going to be a much lower stock market. There's going to be 10-year yields that may touch 5%. They're 4.35, 4.4 now. Volatility risk will remain elevated, and that's kryptonite for assets. And the central bank won't be able to do anything about it. So in that case, okay, so oil could go from 80 to 100. I think asset prices would well underperform, meaning fall more than oil rises. So once again, not priced. Like the price of oil in December is too high to own assets. Similarly, if we just are here, I think the overall asset market is down year over year. It's down from here if oil remains here. So I think if you look at oil relative to assets, oil says assets are going to perform much worse than assets say. So to long answer short, yeah, it's probably not priced in. Now, at the same time, I got to tell you, I'm a buyer of all assets. I just want to get a nice entry point. I have bids in for 2-year notes above 4%. I have bids in for stocks to go to, from a modest short to quite long, below the market, but not far below the market. Like I wouldn't be selling here. I'd be looking to buy. And the same goes for long-term bonds. The same goes for gold. I'm a buyer of everything. I just like to see a washout.
Well, this has been great, Andy. Thank you so much for taking the time. We appreciate you coming back on Last Call.
Sure, Jack.
On the heels of that, we want to talk macro. We want to talk about narratives. We want to talk about the way policymakers are telling the story. We've got Ben Hunt. He explains in this clip this common knowledge moment that he thinks we're having right now. So, Jack, we were with Ben after the Biden debate when he said the cat's out of the bag. Everybody knew there were issues with Biden in the presidential campaign, but once everybody knows that everybody else knows, it changes the dynamic. Ben thinks the same thing just happened with Iran, with the Strait of Hormuz. He talks us through what the implications are, why he thinks this is a common knowledge moment, and then even the paper portfolio that they use over on Perseant Pro. He explains what some of those trades look like.
And it's been really shocking how right Ben has been about a lot of this stuff. Like, I'm the tendency to be the optimist about everything all the time. And like, so when Ben will say like, this is the way this thing's going to play out, I'll be like, yeah, that's probably not going to be that way. But I mean, he's been spot on. I mean, not just about what obviously that Biden common knowledge moment back when we were doing breaking news, but like about this whole thing. I mean, he saw a lot of how this was going to play out, like before a lot of other people did.
It's interesting because he tends to see this stuff in advance. There's a real Cassandra thing going on with some of this. But then on top of it, to understand how he's watching it in real time, I think is really, really useful. And whenever Ben comes out and says there's a common knowledge moment, that's where part of my brain starts firing, going like, uh-oh, you've been paying attention to this, but now you really need to dig into what he's seeing. Ben, you've got a new note out for Epsilon Theory that's live on panoptica.com, the new merged site. Congratulations. And I want to talk to you about this note and the portfolio changes I saw come through for the Perseant Pro subscribers. So where do you want to start? This piece is wild.
Well, so we've written a lot about what's known as the common knowledge game in the past. And I think the best way to describe what the common knowledge game is an example that we're all familiar with, which is the emperor who has no clothes. Right? So we're all very familiar with that story, and there's a logic to how that story works. Right? So the emperor is walking down the street, naked as a jaybird, as we used to say down in Alabama. And because he's been bamboozled by his advisors and courtiers, right, that he's wearing this beautiful set of clothes that's just, invisible. It's so fine. And so he's walking down, and what happens, of course, is that the townspeople, the people there on the street watching him, they all have private knowledge that he's naked. They all see with their own eyes he's naked. But it waits, where the story goes, of course, is that there's the young girl who yells, and this is important. She yells loud enough so that everybody hears her. He's got no clothes. So in game theory terms, we call the little girl a missionary. And what a missionary does is it transforms private knowledge or even public knowledge. We're all seeing the guy's naked, but it transforms it into something that we all know that we all know. That's what common knowledge is. It's not that we know something, it's that we all know that we all know. And that changes everything. So some examples I've given that in the past were with Weinstein, right? So everybody knew he was a serial rapist. I mean, everyone knew. They made jokes about it on what was the show? The 30 Rock, the show, right? They made jokes about it, but it wasn't common knowledge until a missionary, a famous person, a person who, when they speak, everybody hears it. In this case, it was Rose McGowan, said, he's a rapist. And once she said something so loudly that everyone heard, everyone changes on a dime. They're all, oh, I'm shocked. Right? And nothing changed in reality. He was a rapist before, he was a rapist afterwards. People knew about it. But the world changes when everyone knows that everyone knows. Another great example we wrote about, Joe Biden's debate performance. Right? So there were people talking about, oh, he's not all there mentally. And certainly the people around him knew about this. And like I say, it's kind of publicly people would talk about it. But it wasn't until he's at a nationally televised debate performance when we could all see, and more importantly, we all knew that we all were watching. That's what changes things. It's an interesting twist. It's not what you know. It's what we all know that we all know. And it's driven by something that happens very publicly. So publicly that we all see that we all saw it. And that's what's happened with this Iran war. So I call it Trump's war in Iran Strait because it's Trump's war. It's a war of choice. It's Iran Strait. It's the revelation, what this war has revealed, what the what the market is yelling out at us as the little girl, as the missionary, is that, oh my God, the Strait of Hormuz means everything for the global economy. That if you're an oil importer, if you're Europe, if you're Japan, if you're any emerging market, you're screwed, right? If the straits are shut down. And this has been out there for a while. People always talk, oh, well, what happens if the Straits of Hormuz are shut down is a very important thing. But this is a common knowledge moment. We all know what happens when the strait is shut down, and that changes everything. In particular, it means that now we all know that the world runs, the fulcrum point for the global economy is the supply of energy through the Persian Gulf. Period, full stop. And so it matters so much. It's always mattered, but now it's the only thing that matters is whether you're an oil exporter or an oil importer. United States an exporter. Why is the dollar strong? Why is gold not working with this war? You would think gold would work here for all the right reasons. It doesn't work because that's not important right now. What's important right now is, are you an oil exporter like the United States or an oil importer like most of the rest of the developed world? It just reveals what people knew privately, but now we all know that we all know, and the world will never be the same once that happens. That's the impact of this Iran war.
Comment on the common knowledge around it, the awareness now that this really is Iran's strait. This has far-reaching implications that we're admitting Iran basically owns, operates, runs, dominates this space.
Exactly, right? So that's always been true privately, but now it's been revealed. And because it's been revealed, Iran can A, use this to get the war to stop, like they're doing, to preserve their nuclear, enriched uranium, to keep their regime from being bombed out of existence. That's the card they play. And it's going to be incredibly difficult, I think impossible, for any outside force to hold the strait against the asymmetrical warfare, the cheap warfare of drones and the occasional missile shot down from the highlands. They're just a few miles from the critical shipping paths, shipping lanes. So there's no way to dislodge them from this fact of geography that they control it. All that's possible now is to work out some modus vivendi, right? Some way of living with this, where, they're saying we want to charge ships for transit in the same way that Egypt charges ships for transit through the Suez Canal. That's what's happening right now. I don't see how that stops. And so, but the broader point is that now it's just been revealed, and we all know that Iran owns this, and it protects them in a regime sense, but it also reveals the weakness of the entire world for an energy dependence that the rest of the world has, the United States doesn't. So why is the dollar working? Why is gold not working? This is it. And from a portfolio perspective, for me, it means you got to own energy companies. I don't know what's going to happen with the commodity itself. I'm interested in owning the commodity itself, but the volatility that goes up or down, what I know works in this situation is to be long energy companies, because that's what matters in the world today.
So explain this. You have model portfolios or a model portfolio that you run. So it was a Sunday, mid-month, I see the email come through from you for the model portfolio update. That's basically going, big news weekend. Here are changes that we're making in this portfolio that we're tracking. Explain what those moves are. Explain what pushed you to the place that it pushed you to, from and to.
Sure. So model portfolios is something we publish for our subscribers for our professional service. So that's it. Some people run there, and then what you do with that is up to you. It's a long, short, go anywhere, do anything. We'll express it in ETFs and single stocks, very plain vanilla stuff. And what we had there was a significant long position around de-dollarization. So long positions in non-US equities, Japan, Germany, China, stuff that's been working really well up until the invasion. Once the invasion happened, and it came clear to me at least that the story has changed. The story has changed. The common knowledge of how the world works has changed. Sold all of our long exposure to the oil importers, Germany, Japan, China. And what we also put on was a new long position just in the energy sector, just in the XLE. That's it. Don't need to be too cute about this, but it's a recognition that when the world's common knowledge shifts, this is an investment theme that lasts for a long, long time. So getting out of being long ex-US, the oil importers, and starting a long position in just the energy companies. Again, don't have to be cute about it. It's a big long-term theme that reflects the way that the world's common knowledge changed with the invasion or the attacks on Iran.
So if you haven't seen it yet, at Epsilon Theory on Twitter, Epsilon Theory online, panoptica.com online, connecting the supply chain to the kill chain. That's one piece. You've got more coming out on this topic
More
in the
coming.
very near future.
More
Anywhere
coming.
else you want to send people to bug you on the internet and read this stuff?
Sure. So I'm Epsilon Theory all over the place. That's the easiest place to find me. Our company name is Persient. So you can look there, and our professional offering is pretty cool.
Great. Ben Hunt, thanks for joining us.
Thank you, Matt.
So the third lens we're going to look at this through is flows. And, Brent Kochuba, I love talking to Brent. I get to talk to Brent every month on the OPEX effect, but Brent sees what people are actually doing in terms of like what options people are actually buying, where they're putting their money, not just what they're saying. And there's a really interesting trade coming up, this JP Morgan collar, which he'll explain it. But at the end of every month, there's this JP Morgan collar trade. And when we get near the prices of that trade, it can actually impact how the market acts. So we'll talk about that and a bunch of other stuff. So here's my interview with Brent. Brent, welcome to Last Call.
Thanks. I'm excited to be back. Surprised you asked me to come back. Thought you'd have a little too much Brent, but here we are.
Yeah, well, I always want to get your insights on what's going on behind the scenes. And as you know, I've become one of the world's leading experts in the Strait of Hormuz now. So,
Yes.
I want to take my macro knowledge of that area and translate it to what you're seeing in the oil market behind the scenes with the flows. So we can bring these two expertises together.
That's right. I'm still thinking about the STRAIGHT, so I clearly don't know what's going on. It's like the
Yeah. Well, I actually didn't even know. Before this thing happened, I was like, I didn't even know which countries bordered the Strait of Hormuz, but I did look that up online. So now I think I'm qualified to write a book. So I've got ChatGPT working on the book right now. It'll be out shortly with my analysis of how to handle the situation and the future of the Strait of Hormuz.
Yeah, on this topic, it's actually an interesting one because I'm old enough to know, they say, Jack, at some point you get old enough to know that nobody knows anything. And that's kind of where I've landed on. It's like, there's a lot of experts out there who are very knowledgeable and smart people, but nobody could possibly have any idea what is going to happen, in a day, much less, 2 months from now. It's so impossible to parse through here. So
It's
with
funny.
that being said, we're going to forecast stock prices today.
Yeah, exactly. It's funny. Andy Constan talks about this idea that like he wants to follow people who have domain specific knowledge and low confidence.
Yeah.
And like those people are basically don't exist anymore.
Yeah.
Like even the people that are know everything about the Strait of Hormuz, like they're telling you all these different things, like they know what's going to happen, and nobody really knows what's going to happen. But what I am excited to talk about is what you do see is what's happening behind the scenes with oil, and I think you had some interesting stuff you were seeing that you want to talk about.
Yeah, and I don't strictly cover the oil market. It's usually something that I don't pay any attention to, and I don't have any hot macro takes for everybody here. But I do have levels, and the levels are interesting because they tie directly into the equity space, and the way they do that obviously is because, as everybody now talks about, we talked about this on the OPEX effect, and I think it was an interesting topic of conversation, and now it seems like common knowledge. But obviously, higher oil means higher rates, which basically just destroys the stock market, right? Because of inflation and credit problems and everything else. We also had a nice conspiracy corner, Jack, about this in the 2008 comparison. So go check that out. But at any
Yeah, our
rate, in
last
this
OPEX
case,
effect, we had a really good one. I made a nice cover for you too, if you remember. I did some good work with ChatGPT there.
that's right. You can make my face look even dumber than it does now, so I'm appreciative of that. But on your screen here is oil, and you can see here's the the Iran situation happened, and the level that we're watching here is 100. And the reason I watch 100 is obviously the crude oil has rejected, and I'm just looking at CL here, a couple times from that level. And, roughly speaking, what I believe is over 100 is the sign that, we are all in a lot of trouble here in terms of asset prices. Basically what's happening is as oil goes up, all other assets go down. And the other thing that is really catching my eye here is the link to vol. So in the magic of presentation, I just added on here the VIX. And what you see here is that normally these two are not very correlated, right? VIX trades as it does, oil does its own thing, the two aren't linked, and then you have these conflicts or these situations like we have today where they're really very closely correlated. And so as you can see here, the VIX, which is currently at 28, it really started to wake up today. And my founder's note this morning was all about the weird move in vol relative to how much oil is moving. Oil is up today, and the two are highly correlated, but vol VIX suddenly seems to be really at the ready, which is interesting. And the reason I care about 100 in oil, because I think if crude breaks 100, I think VIX goes to 50. And then I think the equity market probably has some very, very ugly days. And in this respect, we've not really had a bad day in S&P, right? We've had down days and a string of them, but we've not had that like 3%, just makes Wikipedia kind of move, right? And I think if oil breaks 100, we're going to see that, and that's one of the things that I'm really quite worried about, and it's why I'm watching $100 oil so closely here. To the other side, if we get under 90 in crude, then I think that's a sign that people believe that there's an end to this conflict, and then vol gets smashed, and that makes equities rally, somewhere in the order of 2 or 3% within a day.
Yeah, it's interesting when you see like a crisis, how VIX becomes correlated with the driver of the crisis. Like I would bet like long term, the correlation between VIX and oil is not that much. But like because oil is driving this crisis, like VIX and oil become very much tied together.
Yeah, and we actually posted a chart like this morning in Twitter, and so you can go and see this if you want. But what I did was I just showed the change in USO because it was kind of the most liquid thing I had related to oil. So a rough proxy of oil, and then versus the VIX and one-day changes. So you can see that scatter plot here, and the smart guys on Twitter, of course, will put on it too that there's not really much of a correlation here. It's just a blob, and that makes sense. Why? Because on a normal day, no one's talking about oil, right? No one in the equity market cares about oil at all. The oil traders have their own thing going on. The equity traders have their thing going on, and they don't really overlap. Now we're obviously brothers in arms here, and you can see over the last 5 days, which are the black dots, oil up, vol up, right? That's how this is working. Equity vol up. And today, this morning pre-market, you saw this red dot, which was the excess move in VIX relative to crude. The reason this matters to me is because if anything, the equity volatility market's kind of been a little sleepy or a little sluggish, and you're kind of going, hey, shouldn't there be more concern here? And other people are saying, well, there's a pretty big premium in, let's say, the VIX relative to how much the market's actually been moving, and we've talked about this a lot over the last couple of discussions we had. So the weird thing that I flagged, and I wrote a lot about this, was equity vol is moving a lot all of a sudden, and what is going on with that, right? I honestly don't exactly know. The first thing you'd point to is oil, and oil is up, but it's not up as much relative to the vol move. And so something is shaking here, and it's a little bit nerve-wracking, especially when you see, okay, now today the S&P is down 1.5%, which is a bigger move than we've had. Is something really brewing here that some smarter people have figured out.
Yeah, it's this idea of investors have this idea that it's gonna always come back down because that's kind of been the type of market we've been in. Whatever it is, if the market goes down, it's going to come back up. If oil goes up, it's going to come back down. Maybe the part of this is tied to the idea that if it doesn't come back down, you start to see a little more worry reflected in the VIX. But I also have no idea what I'm talking about. So that's just an note.
We've been taught since the great financial crisis to buy the dip and buy every dip, and it always mean reverts. And so we're 3 weeks into this situation, and let's hope that this is an ultimate buy the dip, because I don't want the world to end this way for sure. But something's baking. Now, this is a challenging period for me to sort of watch the navigation, right? My headline here is if oil goes over 100, I think VIX is going to 50. everything I say after this doesn't matter if oil goes over 100, right? Oil goes under 90, then I think vol gets smashed and we really ramp. If you're going to say, Brent, what scenario to bet on? I think that oil probably stays in this $90 to $100 range roughly, and we stay weak in the equity market. But what I'm want to point attention to is the JP Morgan collar trade that expires on 3/31, because most people probably don't know this position exists. Now, when you go to look at our system here, we call this trace, and the reason I bring this up is because we have this thing called net OI. And net OI tracks buy-side options positions in real time. And there's two big bars in here, Jack. As you can see, there is one here at 6,500, and there's another one here at 6,475. Now, that net put position there is 24,000 contracts roughly. And then you can see just above it, there's about 45,000 puts at 6,500. So this zone, 6,500 to 6,475, is a big one. And the reason we're watching that is because on 3/31, this big fund called the JP Morgan Hedged Equity Fund has a put position that is expiring. And that position itself is about 35,000 contracts. There's some offsetting positions why it's a little bit less showing in that screen. But we know these positions expire on 3/31, which is Tuesday, right? The market tends to respond. And if we're near that strike, call it within 0.5% to 1% into early next week, that strike is really going to dominate the equity flows. And that is true unless oil goes over 100, right? If oil goes over 100, forget everything I'm saying here. But if it stays under there, watch for the market to pin or really use that level, 6,500 to 6,475, as a major area of support into that date because of this big position. Now, if we look at this in gamma terms, which I know is another step in complication, I just want to show you this. Right now, the gamma at that strike is about $20 million, as you could see, Jack. It could get as big as a couple $100 million if we're near 6,475 as we get closer to that. So what does that mean? That means there's a couple $100 million constantly hedging just to that strike into 3/31, which is likely enough to keep the equity market pinned or contained in that level. Again, assuming oil in the Iran situation doesn't get materially worse.
Yeah, so the idea is we're likely to pin in that area unless something wild happens on one side or the other with oil between now and then. We're likely to pin, and then after that, that won't matter anymore, and we'll move on to whatever the next tweet is.
That's right. Barring oil over 100, which would come with whatever escalations come, or we actually have a legitimate deal and everyone agrees. I guess it's a tri-party thing now. We have to have Israel, U.S., and Iran agree to a deal. Then we know it's a deal, right? Then obviously we could have a very, very, very violent bounce, 3% in a day kind of thing. But if you're barring that, watch that strike. Now, some of you may be saying, hey, Brent, this doesn't make any sense that one strike could hold the market up in this type of environment. And we talked about this in the OPEX effect. If you remember last year, Jack, we were having a pretty tough market in March into April, right? Because of the tariff situation. I paused in the tariff situation because that was another one that seemed somewhat self-inflicted. And I guess that's what this feels like in some ways too. But at any rate, the black line is the JP Morgan collar position for put position for March 31st. That was at 55.65. And what do you see here, Jack? We see after February, S&P sold off, hit that level into March OPEX. We got a little bit of a bounce off of that strike. We rallied, and then lo and behold, we come back. We test that strike on 3/31 expiration again, right? Which is when the position expires. Now, once the position goes away, there's no reason to think that the market's going to use that as support anymore, right? So the rhetoric around tariffs, et cetera, got much worse into April, and then we absolutely plunged, right? And we were looking into the abyss of the end of the financial system, I suppose, in mid-April. So that was quite ugly. But you can see, hey, it kind of looks like that strike served as market support. And there's a lot of reasons. There are a lot of times we see the market pin to or hold to either the call side of this JP Morgan position or the put side. There's both on every quarter. And this is a position that systematically rolls every quarter like clockwork and has been doing it that way for years. So it's very easy to track this position. But it's evidence that the market is supported by that strike. Now, again, on 3/31, that strike is going to go away. So does volatility then wake up? Distinct possibility and something to think about as we move towards the middle to late part of next week. But for now into Tuesday, this is the level that we're watching.
Yeah, and this is why I always like talking to you about this option stuff, because these levels, I would have no way of knowing this, and you see the market respond to certain levels, and it's good to just understand whether you're doing anything with it or not. It's good to understand behind the scenes, like what's going on when that type of thing happens.
Yeah, and if you just think about it, the dealers have about 30,000 short puts on related to this position. They're incentivized, and with millions and sometimes billions worth of dollars to get the market to close above that JP Morgan strike to get it to be worthless at expiration, right? So from a kind of a maximum pain perspective, it makes sense. And, there's a lot of offsetting positions and things like that around the strike. So there's just a lot of traffic in that zone, which makes it this sort of support region. Now, if you want to look quickly at the history, this is not a beautiful spreadsheet, but what I highlighted here is this is the history of the positions. Twice in the last, in 2022, we tested this strike, the downside strike, and that's what you could see here. So the put in this case, the long put position for the fund, 45.10. We closed at 45.30 on the day of expiration. 2022 is a pretty nasty market. Same thing in September of 2022. The strike was at 35.80. We closed at 35.85. So, non-random seeming that we seem to close at those levels. As far as last year, 331, the put was at 55.65. Market closed at 65.11. But as we saw on that chart, we were really in a very wild time right on that strike. So other than COVID, 2020, March of 2020, we really blew through that strike in a major way. You can make an argument that was a pretty exceptional period, right? And that position may have been smaller. I don't have the data on that. But the point is that the put side has not been tested that much throughout these last 5 years. But when it has held the market up. So again, as long as oil stays under 100, I think 64.75 will be the floor for the next couple of days. And then the other critical thing is after 331, I'm looking for volatility to really start to increase and swing a little bit more. I would argue that we haven't been moving all that much on an intraday basis, and that could change mid to late next week.
Yeah, and we're probably in for some more excitement here between now and the next time I talk to you. I'm sure we're going to have all kinds of events and tweets and all kinds of stuff going on. So
that's right. They say, may you live in interesting times. And Jack, quite frankly, I don't know that I want to live in these interesting times anymore.
No, I don't either. But we will keep talking about it, though.
Let's have
in
it
the
chill
podcast.
out. That would be nice.
Thank you, Brent. I appreciate you doing this.
So Andy Constan walked us through the oil shock. Ben walked us through the narrative situation as it stands with Strait of Hormuz, this common knowledge moment. And then Brent gave us some insight in what's about to happen as we go into the end of the month here on these option flows. This whole tail is wagging the dog is wagging the tail. Does it feel as confusing to you as it feels to me, in the sense of just like how much uncertainty is actually baked into this market?
Yeah, no, definitely. And, one of the things that it was interesting about a lot of the different guests we talked to here is this idea that, and it's starting to reflect it now, but we had this situation where we had like this negative news that wasn't necessarily reflecting in the market. And it's interesting to hear about that. Like, as we've talked to all these guys, like Brent will talk about it from the perspective of, well, there was an OPEX that just needed to clear. And, then maybe some of this negative stuff will be reflected. Other people are saying, well, we've been buying the dip for the last however many years and it works every single time. So that creates like a dynamic in the market. So I have no idea where the market's going to go, but that was just an interesting thing for me to think about. Like, we're not seeing the negative news reflected in the market. And there's probably a lot of dynamics across the different people we talked to that are maybe the reason that's happening.
What do you think about, because this evolves, right? It evolves until all the negative news eventually gets priced in. And I'm not saying at all that we're necessarily there yet, and hence why we're talking to smart people to try to understand this stuff in advance. But what's interesting is like how much of this stuff is already in the market and trying to get a sense for this. Anybody you're listening to or watching on that front?
No, I did call our episode with Bob Elliott this week, "Nothing is priced in," because he said that in the episode. So it's hard to tell. I mean, and again, I don't know. Like, I think Andy was a little more conservative in terms of maybe some more stuff is priced in than Bob thought. But that's the problem, is no one knows what's priced in. It's impossible to know that, and it makes it very challenging, like to navigate these markets when you have no idea. But it also, and this is something we talked about with Bob Elliott this week, is like you have to have some humility because of that. Like if you're the person that's saying, "Oh, I know for sure this isn't priced in," or "I know for sure this is exactly what is priced in," that's a bad place to be in, because you're probably way, way overconfident. And, one of the things I was remembering, someone pointed out to me the other day, is like, after the tariff situation, we had like a 9+% up day on the S&P 500 in a day, I believe, which is insane. So it's just to think about like, oh, there's negative. But on the other side of this thing, and this is going to be a much harder thing to taco, I think, than the other stuff was to taco. But if there is some way that they find a path to that, like, you could get ripped. If you're negative on this, you could have a ripping rally that could come off the backside of this. So that's why it's so hard to figure it out.
Yeah, all I keep thinking of and keep feeling fortunate about is this is why you have a diversified portfolio. Like
That's
this
right.
is where, and I keep going back in my mind to the Vitaly interview that we did, where Vitaly was like, the more my uncertainty like goes up or the less confidence I have in things in the portfolio, the more things I hold. And he's mostly talking about stocks and those allocations here. But it's like, I feel that on a portfolio construction level, you have to spread those things out because you have to now bake in your ability. Well, you should have already, but if you're not, you should be thinking through how you're going to be able to press rebalance through this thing for the assets that you've saved. Like you need flexibility here to handle this stuff. And that means you need a bunch of hopefully at least somewhat uncorrelated assets.
And I know this is why you and I are both 4-quadrant type guys in terms of the different economic outcomes that could happen. Is like, who knows what's going to happen? But like, I'm a big believer, stocks and bonds were exposed to certain, quadrants where they didn't do well. So it's just a matter of like trying to find things that have positive returns over time and then trying to protect yourself across all that. And that doesn't mean you're not going to go down during a certain situation like this, but it at least means you're not going to be as concerned about it. You're going to know you have something that probably will do okay, in all these different situations. And I think to me, that's the best way to handle something like this rather than trying to predict it.
That's why you stockpile Beanie Babies, right?
Oh,
Yeah.
you can imagine the Beanie Babies are everywhere, Matt. When that day comes where those things go up, it's more like these Nidos and like the stuff the kids are buying these days. Like my kids are buying all this stuff. I just hope someday jelly cats, like the most expensive stuffed animals of all time. Like I'm hoping someday like all that stuff is going to be like some sort of collector's item that I'm going to profit from, but probably not.
If the base rates are right, surely it's.
I'm in huge trouble basically. I think the base rates are against me on this one, I would say.
All right, I want to take us to Eric Pachman. He's our last stop. Eric Pachman at Data for the People. He did some amazing work. We've had him on the show multiple times when he was with Ban Creek Advisors, talking about inflation and the unemployment data. He's put up some new stuff. It's been on Panoptica too, and really looking at the trend in both how we think about the unemployment rate versus the labor force, how the same numbers can tell wildly different stories. And he's created this interactive tool to basically show over the last 10, 20 years, we've seen a shift inside of the US. This helps explain the K-shaped economy. This helps explain a lot of both the lived experience of us in the United States right now, but also the health of the economy going forward. Have you gotten a chance to play around with that, with Eric's tool yet?
I haven't yet, but I know you have rave reviews for it, so I do need to do it.
I'm telling you, you want to go to Data for the People, look at the labor force tool, and look up the place either where you live or where you're from. Look at it over a period of time and see if it matches the way you think about that area. It's eye-opening. I want you to hear Eric and how he explains this and compares these two counties to each other. I think this is profoundly insightful to where we are right now in the U.S. economy. Eric Pachman is with us next. He writes for Data for the People. That's his site. Make sure you put the number 4 in that name. So Eric, you wrote this piece. We shared it. It was on Panoptica and on your site. It was basically the systemic hemorrhage. You've been obsessed with the employment numbers and all this stuff. First off, why are you obsessed with this? Where does this come from? Why should we care?
Well, I'm gonna have to rewind back about like 2 years, and I started looking at both inflation and jobs data, and I was like, I'm a data analyst, data visualizer, narrative storyteller, and so I was like, these two numbers are really three numbers, right? Inflation, CPI, PCE, non-farm payrolls, and then also the unemployment rate. Like they move billions, if not trillions of dollars in market cap, when they come out. And so when you actually look at the data sets, like there are very granular data sets where you can drill all the way down on the inflation side to the item level, so eggs or whatever. And then on the job side, all the way down to what's called the NAICS hierarchy, so North American Industry Classification System. And so I was like, well, where are the free interactive data visualizations so I can see what happened? Like, I mean, I don't really necessarily care if the job number is plus 130,000, if it, like, say, all came from healthcare. I wanted to know. And people, and by the way, healthcare and education are like grouped together. So it's like, why would anyone have done that? And so I took the Bureau of Labor Statistics data and I put together these data visualizations. And I just was dumbfounded staring at them. And I wrote about them month after month after month because we were seeing like basically a jobs recession forming in the middle of 2024 outside of healthcare. And then we're just waiting for that healthcare shoe to drop, which it finally did last month.
So this is part of why we wanted you on this recap, because
Yeah.
suddenly people are aware of, oh no, look, like jobs have been lost. You've been saying, no, we've been losing jobs everywhere but healthcare
Yeah.
up to this point. And you've also been pointing at what a larger structural issue that is. So maybe break down the number, break down NFP, break down the space
Yeah.
a little bit more, and why right now is just indicative of a bigger problem.
Yeah. So with non-farm payroll first, you have numbers that, were coming in the, I don't know, anywhere from 50,000 to 150,000. But if you look directly at our free tool, which is on my prior employer, bancreek.com, you can go back and look and see how many healthcare and social assistance jobs comprise that. And all the way up till the end of last year, if you looked at the total number of payrolls added versus the healthcare jobs, it was like over 100% of all the jobs added were in healthcare. I think it was like 150%. I mean, you can go pull the number yourself. But so we were seeing that we were losing jobs everywhere else. There was there were dynamics within like management services, like where we had never seen in the history of the data a decline in professional management services. So this is where all like, lawyers and accountants and all of them live. And we have been seeing a decline in that since like before AI even started. So like since the middle of 2024, that's been in decline. And it's the first time out of a recession that has happened. So we were flagging all of these kind of really interesting things. And then also talking about how healthcare, like, look, it can't go up, 80,000 jobs every single month. But yet it did. It was wild how like, we were looking at it going all the way back and we're like, okay, one of these months it has to take a breather, but it just kept coming in month after month after month and making the high level aggregated number look artificially kind of great or okay. Like the economy was still adding jobs, whereas like, at some point in time, we knew that was just going to kind of back off. And then not to mention, like when we wrote about this at the end of last year, there's Medicaid regulation that's coming right now where the Medicaid programs, the funding is going to be cut by 10%, which is really going to be taking an axe to healthcare jobs. And I think that's going to kind of cascade through the whole system. So what we really wrote about was like, look, these can keep going up and up and up. But when you get to 2027 and this regulation kicks in, I mean, you're going to have elderly daycare centers, home healthcare aides, like all of these things, millions of jobs taking care of our seniors. They won't be funded anymore. And so it was just a matter of time. It just happened that, for a prognosticator like me, Christmas came early last month and healthcare just declined. So I don't know if that's the start of a trend, but I do know that I'm very concerned in 2027.
What I do think is start of a really interesting trend, because you can map it back to the roots, is in this piece. So let's just talk for a minute about, because we know what the headline stories are. We know what the national stories are. You looked at Clark counties, plural. Talk to me about what was going on in those two places, sort of summarize what you found, and how the same numbers can tell such different stories when you get into the details.
Yeah, so this is where it gets into how, and by the way, the first one was Perry County, Alabama, and the second one is Clark County, Nevada. So this gets into, we talked about non-farm payroll and why that can be misleading, especially when you're looking at high-level numbers. The unemployment rate. Unemployment rate may have been a good indicator, but I think we vastly overweight it as far as how much we pay attention to it, because it doesn't include, in the denominator, it doesn't include people that are not actively looking for work for the last 4 weeks. So those people are just dropped out altogether. We have a baby boomer retirement kind of thing going on right now, and so, you can see this in the piece, like the 65 plus demographic is just booming. And so you have communities where 65 plus, like they only have an 18% labor participation rate. And so they're not working very much at all. And so when you get this wave of retirement, you're just going to have less workers available to work, and you're not going to see that in the unemployment rate. And so what I did at the start of this is I just kind of put like, it has to pass the sniff test at the end of the day, right? Like we have to be able to put a story to this. And so I'm like, let me find two places that have pretty much the exact unemployment rate. Perry County, Alabama, which if you actually go on Google Maps or Google Earth or whatever, I mean, it's a crumbling town, for lack of a better word. Like if I live in Ohio and I drive all over rural Ohio and like the downtowns are boarded up and everything. I've been, in and out of many of these towns before, so I know what they're like. That's 5% unemployment in that town. It's not 10, it's not 20. There's so little work there that people have just stopped looking for jobs altogether. So it's 5%, which we're like, that looks good, or at least not that bad. Las Vegas, Nevada, Clark County, Nevada, that is also 5%. And so that number, especially when you get down to a granular level, a county level, which is where I think we need to go to be able to understand each other's different experiences of this country, not an aggregate number. Unemployment rate just doesn't help at all. So I was like, well, what does help? And that's where I came across the labor force. And that's what this entire piece is about. It's about taking a number that's very tangible, the labor force. And I put multiple kind of, esteemed white papers in here to basically say, like, lots of economists who know what they're talking about, unlike me, they are telling us that, like, look, and this makes sense. Like, if the labor force is growing, there will be more tax revenue in the city. They'll have more money for services. They'll have, and you can basically attract more people. Employers like it, especially manufacturing plants. They really like it when you have a growing labor force, more supply, lower rates. Like, it just makes sense based on just kind of Econ 101, right? Now, if you have a labor force going in the opposite direction, you can start what I call the cycle of structural decline. And what I've found is that if we looked at the data through the end of 2010, I defined structural decline as a county that lost 10% or more of its labor force over a 20-year period. There were only, I think it was 8% of counties that fell in that bucket. And it was like isolated areas, the Black Belt. There were parts of, like, northern North Dakota and stuff, but it was very sparse as far as looking at, like, this very large 10% decline in labor force. Fast forward to 2025, the end of 2025, and if you look at the prior 20-year period, so 2005 to 2025, 32% of all counties are in structural decline right now. And when you look at rural America, so the smaller the county is, the more likely that they're in structural decline. And so this is just basically a way to visualize and understand what has happened to America. People have left rural towns. Manufacturing is leaving rural towns. The working population, or what's called the prime age workers, are thereby fleeing, going to the cities, trying to find jobs there, trying to find gig economy jobs, whatever it may be. And then all of a sudden you end up with, like, Nashville and Austin, where there's such a boom that the wastewater treatment can't keep up with it, and they're worried about crap being in their water. Like, I was just there and heard about this story. So, like, it's crazy. It's like, you either have towns that are dying or towns that are booming so much that they don't even have the infrastructure to support it. So it's this wild dynamic that I hope I really brought to life with this visualization.
I want to emphasize again, this isn't to make a specific, like, macro call or forecast on what happens in the next 6 months, but say again one more stat, because I just want to go out on this. The difference again between the 2010 20-year look back and the 2025 20-year look back in those structural decline stats. Repeat it one more time.
8%. There were only 8% of all counties in structural decline in 2010, and now there's 32% of all counties in structural decline as of the end of 2025. And you can see it right on the map. The visualization makes it really easy for you to only look at, only the rural counties and so on and so forth. So if you want to look just at metro, like the largest metropolitan areas with more than one people, they actually don't look that different as far as their growth. They've had, like, a nice upward trajectory. The rural is a completely different story.
If you want to see the tool, check it out on dataforthepeople.com. Eric, where else should people find you, bug you on the internet if they want to stay on top of the story?
Yeah, email me, eric@dataforthepeople.com, number 4 again. You can get me on Twitter, just Eric Pachman, LinkedIn, Eric Pachman. My personal blog, Reclaiming Soulfulness, if you want to learn a lot more about me, maybe more than you want. And I think that covers it.
Eric, thanks for joining us.
Thank you.
So, Matt, I can't think it'd be any harder probably to do a looking forward segment right now, because we're probably, by the time this comes out, there's probably going to be 8 tweets that are going to change what the looking forward is. But I mean, I guess the word's uncertainty, right? As I move forward.
8 tweets, and apparently politicians and administrative people explain things with, like, Lego videos, like AI Lego videos.
I didn't even see that. What was that?
There's a new one from, like, the Iranian government explaining, like, it's terrifying. It's like the worst.
They broke out the Legos?
They're breaking out the Legos. I don't even know. Maybe it's not them. I could be reporting fake news right now on this thing. I just know I'm seeing it everywhere. It's got like 2 million views. I click on it. I'm like, well, this is terrifying. We're trolling each other with memes at the highest level right now. I'm with you. I don't think anybody knows what's going to happen next. It certainly feels bleak. We know from experience, the bleaker things feel, the more that presumption gets baked into market prices. I'm scared, per the Bob Elliott interview that's going up, that not enough of that's priced in yet. But I'm intrigued by when I listen to Andy talk about the different scenarios. When I talk about Ben, and I know like with Ben's work, the pre and post common knowledge moments, it's like, that's actually the thing that's the catalyst to the new understanding. Until you cross that moment, there's an experience where like that is just embedded and unpriceable. Once you cross that moment, now actual change starts to happen. I think the question here is like, how fast does this like get worse or ease off? Because if it gets worse, a couple of things like what Brent highlighted, or some settling into the K-shaped economy and the way that Eric paints out what like the situation is in 30 whatever percent of the counties across America, like this, I don't feel good about a lot of these outcomes on the table right now. I don't like that feeling.
Yeah, but one of the things that I always go back to with Andy Constan is, and he didn't say it in this interview, but he said it in our previous one, is he always likes to talk to people who have a high level of knowledge and a low level of confidence, like during a time like this. Like, because anything other than that, even if you have a high level of knowledge, like how are you possibly predicting what's going to happen right now? Like there's way, it's the decisions of individual people. There's all kinds of moving parts. Like nobody has any idea. So like, I think that's probably the biggest takeaway is let's think about like, and again, people like you and me don't do anything with our portfolios anyway. We try to learn from this and we try to, gain experience from it, but we're not actually making any changes. But I think if you are listening to anybody in a situation like this, like that's probably like high level of knowledge, low level of confidence, or the second group Andy said is people who are just really, really smart at analyzing anything. And they may not have a high level of knowledge of this, but they're really, really good at analyzing anything. And I think if you think about those two things, I mean, how much of Twitter would we throw out? Probably like 95% of Twitter would get tossed out in the garbage, right? Maybe that's too low.
That is where I saw the Lego video.
Yeah. Which may or may not be a real video.
Which may or may not even be real. But that's part of the problem. Like I'm watching this going, like there's a 98% chance that this is like nothing. And, some kid made it in his basement in Boise. But this is why we have these guests on. This is why we collect these really smart people. That's why we check in with them in environments like this. And that's why we want to share it with all of you at home. Do you have any other brilliant insights you want to stack on top of this one, Jim?
No, I will just say to add on to that, though, I do like the @Grok is this true thing on Twitter now. I'm like seeing people do that. And I love that because like all these ridiculous takes come up and then like Grok will be like, that is completely wrong on every level. So I do like that. I do like the real-time fact check. It's kind of fun.
I'm waiting. Somebody else was doing like, it was like @Grok with the fact check and then like @Grok do something completely stupid. And it was in the same thread next to each other. I was just like, this is it. This is the de-evolution. It's just, if I sell it all and just go into a quiet room and listen to Devo for the next like 2 weeks or something, that'll be why.
I don't know who I'll do clip shows with, Matt.
Well, another one in the bag. This is our market wrap show. We hope you learned something from Andy, Ben, Brent, and Eric. Check out their stuff. You want to look below in the comments. We'll have some details. We'll have the clips. We just want this to help you. And now you're thinking through the situation and thinking forward into the month ahead. We're going to be back in a month with another round of this show. You're watching Excess Returns. That's Jack Forehand. Oh, check out our Excess Returns Substack too. We're summarizing and putting a bunch of this stuff there. Really cool, really useful. If you're an allocator or an investor of any type, you can learn something here. We're putting the best lessons in writing. Train your AI bots to come crawl it. All that good stuff.
I'll take the views ever and get them, Matt. Bots, whatever. Bring it all. Bring
them all. Bring all your bot friends to this party. This is a good time right here. So thanks for watching. This is Excess Returns. Like, subscribe, comment, all the things below, and we are out.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.